I always love to come back to DataFest. It's now, I think, my third time that I talk at DataFest. And before that, I was always talking about data pipelines, complex data engineering problems. And so I want to talk a little bit about my motivation to why I'm here. So, I mean, I'm investing now 25 years, approximately, sometimes more, sometimes less. And 2 years ago, I thought, why is there no really definitive guide for a tech person to invest? If you look around, most of the books you read, they're written for people with a business administration background, maybe for lay people, but there's no kind of book that teaches how to invest as a programmer or as a tech person. It doesn't have to be a programmer, it can be a data analyst, whatever. You should know Python at least. Yeah? And I thought, okay, what would be if I wrote a definitive guide to investing? And in these 2 years, I came across a lot of different topics. And this talk is in a way a comprised form of all the journey that I had about investing, how you can use data for investing. And it was really an amazing thing because I realized my core hypothesis is always that data people are the best investors because there's a lot of character traits that we all have here. Yeah, there's, I mean, everyone here is definitely intelligent, so everyone is has a high IQ. Then everyone who works with technical systems needs to anticipate problems. We need to think analytical, and this is exactly the perfect environment for investors. And still, a lot of people that I know in tech, they don't really know about investment because a lot of people also have to think that these are different tribes. We are the hoodies, the other one are the suits. And this talk should help to change this. So there's one small disclaimer before I get started into the details. I mean, many of you could be already experienced with investing and finance. For some of you, it might be new. And in these 2 years, I experienced so much situations where I was approached by people telling me that they have found the holy grail of investing. And especially if you go into more newer forms of investing, crypto or so, or let's say advanced trading algorithms, there's often the kind of idea that, yeah, there is a holy grail of investing and there's just one thing you have to do and you get rich. And if there's one thing that I want to say up front, no, that's not the case. So here, there's a lot of things where you can use your brain, no matter if you're a machine learning engineer, a data analyst, or whatever, how you can make smart investment decisions. But there's not a single way to get rich with one method. So the silver bullet doesn't exist at all. And if someone tells you that, then you're you have to be very cautious. So, but enough of the disclaimer. So here, be skeptical. And also keep in mind, I'm not a financial advisor that now advises you to invest in something. So my mission here is to show you some methods where you become your own financial advisor. So where you can find out how you can have better results. So when you think about investing from a data perspective, I found there are many different methods, and the field is so huge that we have to find some kind of guideline, what makes sense, what does make less sense. And although there are now a lot of terms on the slides, we don't need to know everything, but one key differentiator is time. It makes a huge difference if you invest in a short time frame. This means you make a lot of purchases and sales very fast. Or if you invest long-term. So every investment advisor will also guide you, understand how you want to invest and what your goals are. But basically, based on that, you have completely different challenges in working with financial data and finding some insights. And this is often where it starts. And I would love to use this example I don't know if everyone sees it from the back, but basically this is a chart that gives us information about the closing price of a stock. And it's amazingly easy to basically create plots like this because there are tons of Python libraries that just fetch the data from a platform. This was done with Yahoo Finance library. And by the way, all the slides, the code of the slides that are created, all the kind of charts is in a GitHub repository. You can basically clone and work with the data. So basically, I showed it in the beginning of the slide deck, if you want to recreate such plots like that, you just look at the source code. So basically, but this is the beginning. So you have the closing prices, and this is where all starts. So some people say, okay, you see there's a chart, and a lot of people start right away making conclusion. They say, okay, it started on a very low level, so let's a little bit of 140 so somewhere in mid-June, and then now it went hugely up, and then we have a regression. So most people will say, could be a buying signal because we have something that is going up, and now it goes down, and most likely it will go up again. But of course, this is very speculative, but this is, in a way, the very first ways that some people make decisions about to buy or not to buy. I mean, some people might, so everyone knows this company, what's in there, and yeah, but I will disclose what kind of company it is later. But let's look at the short term. So short term, when I talk about short term, I mean trading. This means what is the goal of a trader? This is often you look at exactly this kind of price movements. Yeah? You want to buy something that's low, and then you want to sell when it goes up. And the shorter the time frame, the more engineering like it also gets, because sometimes you need to be super fast to detect discrepancies on the market, and in milliseconds you have to have a buy or sell decision, and then also hardware matters. But in general, the lower the time, the less data you need to look at, because and in short time, mostly what counts is the share price of an asset. Yeah, and I want to outline the difference between a trader, so buying and selling some stocks quickly, to a long-term investor. When you typically, a usual situation is somebody says, okay, with a trading strategy, I look at the current stock price, and when it's down, then I want to buy. Or there are some patterns that you can often see in some kind of charts, where you say, okay, I identify there is a certain movement that this kind of share prices do, and when there's a certain movement, there's mass psychology, and it means that at some point this will happen. It will either go down and go up. And a lot of people rely on that and simply say, when I detect a certain pattern, then I will buy, and if not, then I don't do anything. And this is very different to the kind of different approach when somebody says, I want to invest long term. Because long term, if you think back on this, what does mean long term here? I mean, if you say, if you sell it in 10 years maybe, or the investment horizon is 10 years, are you really interested in the details of the chart? No. So the key message here is this, that basically investing means a different approach on the time horizon. So maybe someone who rather looks long term, and here we talk 5 years, 10 years, looks on different things. He looks on financial data. He looks like not things that might vanish. Also, let's say, interesting is for short term, looking at sentiment data, or something that happens right now. Is there a scandal? Is there something that could affect the price very fast? You look more like on long-term price development. So here in this chart I have here from this stock before the price predictions per year, and the kind of question is, would you look at, here the question is, when a stock will have, when the company will grow in revenues, then most likely it makes sense to buy, and you ignore the kind of short-term tendencies. One thing that you can start when you're working as a data professional is that you look at averages, because one thing is obvious. If you have the data about closing prices, you know exactly what the asset, let's take a share of, let's take stocks, and you can compare it with the averages before. You can definitely say, is it overvalued or undervalued based on the averages. So a data analyst that basically fetches the data through any financial platform can say, okay, having a data frame, I create the averages, and with the averages I say, am I higher or lower, and then I make a buy or sell decision. So this is what a lot of people do, and a lot of people already get some insights based on that. So here, this is the share that I was referring to before. And here, you could see that basically when the price is over the averages, it could be a sign that it's basically overvalued, and then when it's below an average, it's undervalued. So basically, if someone had said, okay, this might be a good sign to buy, this is a perfect example where you could make a buy decision based on averages. This is another indicator. It's called the Bollinger Bands. Instead, again, you take the base, the averages, and then you use the standard deviation, and you create a so-called upper band and a lower band. And basically, if the price is over the upper band, it's a sell signal, and if it's below the lower band, it's a buy signal. And also here, you can see already challenges, because basically you would have a buy signal around here, and as a sell signal. But if you sold, you would have within a short time again the stock going up. So one key thing is that whatever algorithm you use, there's always the challenge that you're wrong. So and this gets even stronger in another example. So this is another stock, and here basically you could say that it's in an extreme overvaluation all the time, because the share price is super high, it's super growing. And what happened here in a way is that this is Google, by the way. There was an announcement that Google was not forced to sell Chrome, and with that it went high. So basically, if the kind of idea is, to make it short, you can always look at some kind of valuation based on averages, but whatever you do, there's always the risk that you're completely wrong. And this is often because there is something in the market that leads to a different reaction. It could be like it here in the case with Google, that there's a legal process that goes out in a certain way. There could be also one thing that you suddenly learn that there's a new growth business coming, so earning calls, surprises. So whenever you look just purely on charts, it's a gamble. And of course, you could say you can create algorithms. This is what a lot of algorithmic traders do. They create algorithms. They say they look at the signals. Okay, one buy signal is undervaluation based on averages or whatever, and you sell on a different signal. And if you look on simple algorithm, what you can do is you can backtest. This means you look at historical data. Let's say you go back for 5 years, 10 years, or whatever, or 2 years, and then you look how would the algorithm perform, and would you make a win or a loss based on a simple algorithm. And for my book, I tried to do that with a lot of different stocks, and the conclusion was that very often there are the trading algorithms where you use this kind of mechanism are not more performant if you bought low, let's say 2 years ago, and didn't do anything and sold later high. And one reason for this is because you have transaction costs. The moment you are on you buy your assets, you have to always consider, no matter which broker you take, that you always have to buy a small amount of cost of a transaction to sell or buy a stock or any other financial asset. So with that, you have an additional risk when you, let's say, have in a longer period 200, 300, or whatever amount of transaction, that you always have additional costs that might reduce your overall performance of a trading algorithm. But what you can do is, of course, you can experiment with a lot of different parameters, try to have an algorithm that works, and see in the past. But the problem is always what happened in the past doesn't really rely on the future. This makes using algorithms somewhat difficult in terms of having a successful strategy. So here are some results from NVIDIA when I tried to run the algorithm with a 20 days average window. So I took 20 days on average price as a basis, and basically the conclusion was if I had bought the same amount of NVIDIA stocks in the beginning of the test, so this was 2 years, I would have made more gains by buying and selling on trading signals. So this is one thing. If you want to use data skills as for trading, that there's a lot of risks that actually your algorithm doesn't perform better than the market. And one thing is also that to consider is that every time the markets always change. There's always different economic situations, and in some things, when something happens, let's say we are now in a recession, but the stock prices go up. So there's a lot of things where the market is absolutely not predictable. Warren Buffett once, or better, his mentor Benjamin Graham created this kind of metaphor of Mr. Markets, and this means anything can happen, and if you have a very undetermined market and a lot of risk and a lot of chaos, that you even can't beat the market. There are also theories on it. There is, for instance, the efficient market theory that says that no one eventually can beat the market, which some other people might contradict, because we have seen a lot of investors who consciously and obviously all the time were better than the market. Warren Buffett, one of them, but others as well. So it's possible, but here this is the kind of message that I want to give is you can explore trading algorithm, but there is no guarantee of success. So you most likely you can program one quite fast, because looking at trading signals, this is something that doesn't go, that is not complex, but finding then the right signals, this is the challenge. And so the question is now, what happens, because I showed you something with just one signal, and this was very algorithmic, but I wasn't yet referring to machine learning algorithm, because basically this was just algorithmic looking at some data. What happens with machine learning and deep learning? So there is a famous book called The Man Who Solved the Market, and this is something that is the basic literature for someone who wants to enter this kind of field. It's about Jim Simmons, which is one of the pioneers in machine learning in finance. Jim Simmons was a mathematician, and he was basically the first one who really said I want to use computational resources to beat the market. And he became one of the richest men in the world. You maybe have seen he was a very awkward person, never wore socks, was a little bit a quirky guy. And his mission was basically to work with people who are a little bit more quirky than him, but brilliant mathematicians. And he created the first hedge fund that was purely based on machine learning. And this book is about this, because normally what happens is no hedge funds, no one who works with quantitative data will tell you about how they work. I mean, you have, for instance, Qualquant here, and if you approach them and ask them, can you tell me a little bit about the algorithms you're using or your technical platform, you will have to sign an NDA, or rather they will invite you for a job interview, and if you pass it, then they explain a little bit what they are doing. But basically, this is the secret sauce, because this is the kind of way you make money. But what you learn out of this book, the man who solved the market, is that there is no single algorithm that you can use to solve the market, because you have to consider the following. The moment you're looking at data and prediction, it gets a very easy, understandable machine, a supervised learning model. Because in the end, you have your labels. You know what you're looking for. You're looking for growth. And you can say, yeah, this is that you can have linear regression. You get right away the idea of using different supervised learning algorithm on top of it. And you can train them. But then the challenge is mostly the kind of features that you want to select, because you have tons of features. These are share prices as one of them. You can look at financial data, such as debt, such as revenue growth. You can look at non-financial data, sentiments. You can big data applications on various topics. So the amount of signals, possible signals that you can explore is huge. And what typical hedge funds do is they provide, there's a lot of data engineering, because you need to collect all this kind of different data and create time series data that allows you to select a lot of different parameters for a model. And then you can, as a researcher, yourself select what kind of parameters you believe in, and then you create a model, and then you backtest again. So you basically validate your thesis against the historical performance. And there's one very detail that affects all of us at the moment, and this is this guy here. And this is, unfortunately, this is absolutely not visible at the moment, because here there's a gray line that is basically going somewhere here. There is a measurement where you see that the long-term prediction, how does the market evolves, and the actual price. So there are different machine learning models, and there are different companies who publish this. And what unfortunately you don't see here now on this slide, but you can, if you download the slide afterwards, you can see it clearly, is that suddenly things go apart. And one of them is Donald Trump, because with Donald Trump, everything got unpredictable. This man is completely, I think he takes also some pride in being unpredictable. And with that, you have a situation where social media posts can affect the market more than the financial report of a company. We have also seen that we have situations where companies report positively, but still the market doesn't work out as planned. So maybe there is one hypothesis that good times where there's a lot of stability creates a lot of good machine learning models, and bad times where there's a lot of uncertainty creates bad machine learning models. And if you ask ChatGPT or any other LLM about that, they agree with that. So the kind of challenge that you face if you work with machine learning models is that you need a lot of resources because you have tons of different data coming in, and and you might have the situation that your model works well for some time, but suddenly something happens and your model doesn't work well anymore. And here I want to give a story from the book, The Man Who Solved the Market, from Jim Simmons, about Jim Simmons. So they had situations where they had machine learning models that brought them continuous profit and it looked very good, but then one day to the other one, suddenly the models didn't work anymore. So then you have to retrain them and you have to find out what's not working. And the kind of idea that you have an undeterministic system, that a system that is always changing, and a model that can anytime produce losses where it produces first profits is scary. So long story short, working in this environment is tough. I mean, definitely there are companies that do a very good job because they outperform the market. But it's definitely one thing that you say, although the kind of problem statement is easy because you have quite a clear supervised learning problem statement and you have very clear where the data is coming from, but doing then the modeling, this can be really challenging and unpredictable. This is just another highlight that basically when you look at the 1 year price targets, this is again NVIDIA. You have partly from the estimates $170 difference. So this means the models also from different companies, because they collect the data from different investment companies, they often go quite apart. Basically, I said all I tell you is how I use data to work, and I can't give any guarantee for absolute success, but if there's one thing I love to use data with, then it's when you work with generative AI and LLMs, because you can work on a completely different way of analyzing assets. So when I mean, of course, they can do the same thing. So you can use images, you can use them for trading, you can images, you can prompt and say, okay, is this tell me about this chart, is this a good or not good, shall I buy it if I want to trade it or not? They can do that because basically they use computer vision and then they say, okay, based on this what I know, buy or sell, but this is not the main application of Gen AI. The main application of Gen AI is mostly that you can research the assets that you're interested in. And this is where I believe there's a lot of insights that you have as a data professional. So there's the statement of Warren Buffett that says, invest only in businesses that you understand. And as someone who tried to invest into businesses I didn't understand, I can tell you this is true. So I tried it myself, and if I look at the portfolios, I had no idea about the business. They're horrible. Yeah? This is not something I often talk about very proudly. But the key is that we are in a way where AI changes how businesses operate and how businesses thrive, and also there are some businesses that might cease to exist at some point because AI takes their place. And being a data professional and knowing which kind of businesses could be the ones that flourish and not flourish, this is the interesting thing, because you can start predicting. And the way you can use Gen AI is simple, because you start first by using them like you can use them like a professional, what a professional advisor does with you. In first, you find out what are your priorities? Yeah, you can say, be a professional advisor, tell me about my investment profile. So ask me about it, yeah? Because this is so you will be asked, okay, what's your target? What's your investment horizon? What do you want to achieve? Some people might say, I want to be financially free and so on. And you can then use this like a dialogue, then how much money do you make and what kind of risk are you willing to take? So these are the classical questions that every human financial advisor will give you. And the moment you have written your risk profile, you can then also give a lot of details such as tax situation, how is it? So you get they know exactly what they can give you when you give this as a context. So this is one thing where you can use GenAI very elegantly, because if you have your own investment profile as a context that for every question you ask them, you get exactly better answers. And of course, I wouldn't ask any LLM something like, tell me what I should invest today or something, because this is, again, we all know hallucinations, we all know that often data is not accurate, but what's really working perfectly fine is when you say, give me some indications. So for instance, if you say, I'm working in AI and I'm curious what kind of businesses might grow through AI. And they give you a list of companies. So let's say this was one example I did with GPT-4, and then there are a lot of companies, and some of these companies I know, some of them not. And then the kind of your job is to use your domain knowledge to verify. So this means you go and say, okay, there's this company and they focus on this kind of field, and do I believe as an AI expert or as a data expert, they have the kind of potential to win the market? Is there something that makes them more valuable in 5 years? Because the moment they make more revenue, it also means that their valuation in the stock market is higher. And this is exactly what Warren Buffett means with invest in businesses you understand. Because, for instance, I tried biotech at some point, and I have no clue about biotech. Yeah? And there were a lot of things that I wasn't aware of that could affect a company. But with AI, I mean, for instance, you know that the demand for AI grows. Okay, what drives AI? So, okay, you know the energy. Okay, what kind of companies produce reliable energy, constant energy? Which companies produce this energy, or what do you need to run AI? Okay, you need GPUs. If you had asked these questions, let's say 7 years ago, so when Transformers came out, and you said, okay, NVIDIA, this is exactly where you get rich. Or you can ask yourself now which question. So you can ask yourself one question. So LLMs, which LLM or which company will produce the best LLMs? You can say, well, maybe the one that has most access to the data. And if you then think, okay, which company has 8 platforms with millions of users compared to their competition who has only 1 platform with more than 1 million users, then you know which is a clear candidate to pick. So, there was something. Okay. Yeah. So also there is different performance in the output of LLMs. I tried many of them. So I tried open source LLMs. I tried the Gemini, Claude, and GPT, and in different versions. And you see that, although of course you don't have any insights how they provide you with financial data, you see that with every version they get more refined also more cautious. So in the very first try, when I started the book, I rarely saw the kind of message, be cautious about what you do, but now in the newer versions of, they more recommend you also to be cautious about your strategy. And you see here in GPT-5, right away when I asked about AI-related opportunities, they very clearly also group it. So basically, there is definitely someone working at these companies that produce LLMs that basically build more refined also for the finance world. Then, of course, as a last topic of this talk is agents, because the one clear challenge of LLMs is that they are trained up to a certain date, and then you don't get any new data. And when I used earlier versions of LLM and I asked about, there's one good example that I have in memory. This was all beginning of the year when I asked, okay, which companies could be affected by that Donald Trump is president, and it was not yet trained with the data that Donald Trump had the second term, and it was said, yeah, Donald Trump also was president, he isn't, and of course, this is the kind of challenge that you face, but the newer but of course with agents you could update the LLM with additional data by simply using RAGs or MCP servers. I also feel that, but this is it's just an assumption, not a statement, that LLMs got better with time on this kind of challenges without this being maybe openly announced, but because the amount of hallucinations that I see over time gets less and less in the finance world. So. But basically, yeah, I mean, here this is a LangChain code where you simply add from finance news into your prompt submission. And with that, you get different results. And one thing that I observed was that this is the more data I provide in addition to an LLM, the more afraid of obviously get that I create a bias with an LLM. This is one of the insights that I also had, that I wasn't so much worried about hallucinations, because the hallucinations that you identify them very fast. So basically this with Donald Trump as an example, it's quite obvious that something is off. But what I realized when I run an experiment where I added the earning calls of companies to a prompt submission. So this means earning call, this is every quarter the companies report on their financial success, and you have a transcript, and this transcript you can add to a vector database, and as a RAG you query it in a prompt submission, and then the moment then of course the results get adapted. And one thing to worry about or to watch out for is the amount of data you get, because the moment it's imbalanced, that you have more data on certain companies. If you look for a specific field, there's always the risk that suddenly with each prompt you submit, you get proportionally more results toward a certain company that you feed data with. So this was one of the kind of things that I also observed. Yeah, personal conclusion. So my personal conclusion was the one hypothesis that I had in the beginning was will LLMs phase out all kinds of software as a service platforms? Because at some point I was curious to build a software as a service platform for investment analysis, and I thought, okay, will we all use in future only large language models that are refined to our specific goals? We use very refined prompts to find out exactly outliers. And I think this completely is obsolete, because I think when I used my own research, my impression will that LLMs are absolutely great research assistants. Yeah? So they hint you to all the kind of possible things that only you see, because in the end it's research intensive. Research intensive in a way that you have tons of opportunities to invest, and you want to pick out exactly one company where you say, okay, this is the NVIDIA, for instance, yeah, because NVIDIA was exactly the kind of company that had something that made them grow faster than others, yeah, and this is exactly the kind of rules that we always learn from Warren Buffett and others. They apply. So this means pick for companies that have a guarantee that to grow constantly, yeah. Pick companies that have a so-called economic mode, meaning they cannot be challenged easily by others. Yeah? And there are some rules. And if there is one conclusion that I draw from my personal strategy, is that basically, you can use your domain knowledge in your data experience a lot if you follow this, and if you use all the tools that you get as a data professionals wisely. So if you follow the rules, like to pick companies with a growth potential, companies that are pretty much safe in terms of their growth, that can rule out the competition. Pick the fields that you exactly know as a data professional. This will make a company successful. This can give you an edge. But the most important thing is also that this kind of edge you need to always challenge. Yeah? So in the moment you have a hypothesis to say, okay, this kind of company wins. Yeah? So basically, one of the hypotheses that I here postulated is that there's one company that has 8 products with more than 1 million users, compared to others that have competitors that have only one product each. With more than 1 million users, and this company is Google. Yeah? So basically, what here I postulate is that Google will be very successful because they have exactly the kind of access to data that no one else has. Yeah? And if you have this hypothesis, yeah, I mean, you can say, okay, this is enough, and I invest. Yeah? But you're here in an environment of other data professionals. Yeah? And this kind of things, this is the next thing that you have to make, is that you can always challenge your hypothesis and think like a data scientist who needs to prove something and wants to be challenged all the time. But this was exactly, I think, the kind of method that I came up for myself, that basically created quite good portfolios and quite good returns. So I mean, I gave quite a broad overview on different methods and technologies and approaches. I tried to be more, let's say, be holistic. And I'm now happy to give you a little bit more time for questions, because to cover this broad range.